Yesterday, the stock market closed at an all-time high. That same week, millions of families put groceries back on the shelf because the total at checkout was too high. Both of these things happened in the same country, in the same economy, on the same day. That shouldn't be possible. If the market is winning this badly, shouldn't everyone feel it? So what is actually going on here? Because the answer is stranger and more important than most people realize. Here's the first thing nobody tells you. The stock market was never built to measure how ordinary people are doing. It measures something completely different. Think of the economy like an airport on a busy holiday weekend. Thousands of people moving through it, families stuck in security lines, kids crying near the gate, flights delayed, chaos everywhere you look. Now look up at the departures board. It shows none of that. It just shows which planes took off and how fast they're climbing. The stock market is the departures board. The economy is everyone stuck in the terminal. You can have record flights taking off while half the airport is miserable. Both are true. Neither one cancels out the other. But here's where it gets strange. It's not just that the market measures something different. It's that the market barely measures the whole economy at all anymore. Most people assume the S&P 500 is 500 different companies, spreading your risk across the entire American business landscape. That used to be closer to true. Not anymore. Right now, the 10 largest companies in the S&P 500 make up around 40% of the entire index's value. 10 companies out of 500, nearly half the weight. That number used to sit around 20% for most of modern market history. It has doubled in less than a decade. So when you hear the market hit a record high, what that sentence usually means is a small cluster of massive technology companies had a great day. The other 490 companies could be standing completely still, and you'd never know it from the headline. What most people never realize is that this concentration has a name and a cause. And the cause is one word you've heard 1,000 times this year: AI. The biggest tech companies on Earth are currently spending an amount of money that's hard to even picture. This year alone, the largest players are on track to pour out over $700 billion building AI infrastructure, data centers, chips, power plants to run all of it. That spending shows up as growth. Growth shows up as stock price. Stock price shows up as record highs on the news. But here's the part that should stop you. Almost none of that money is landing in an ordinary paycheck. It's landing in server racks, not salaries. So the market goes up because a handful of companies are placing an enormous bet on the future. Meanwhile, most workers are still getting paid the same, buying groceries that cost more, and watching rent climb faster than their income. Then something unexpected happens once you follow the money further. It turns out the stock market isn't just concentrated in a few companies. Ownership of stocks itself is concentrated in a shockingly small number of people. Try this stat on for size, because it's the one that changes how you see everything else in this video. The wealthiest 10% of American households own roughly 93% of all stock market wealth in the country. Not 40%, not 60%, 93%. The bottom half of the country, everyone in the lower 50% by wealth, owns about 1% of it combined. Read that again. When the market has a record year, 93 cents of every dollar in new stock wealth is flowing to a group that's already at the top. This is where economists use a phrase that sounds technical, but is actually simple once you see it drawn out: the K-shaped economy. Picture the letter K. One line at the bottom starts and then splits
into two completely different paths. One line climbs upward, steep and fast. The other line drops downward, slow and painful. Both lines start at the same point. That's the trick. It looks like one economy. It's actually two, moving in opposite directions at the exact same time. The people riding the upward line usually aren't earning their way up through paychecks. They're riding it through what they already own: stocks, real estate, equity in a business. The people on the downward line are living almost entirely off their paycheck, and their paycheck isn't keeping pace with what things cost. This changes everything about how you should read economic headlines from here on out. When you hear GDP grew this quarter, that number is an average, and averages are dangerous because they can rise even while most individual people are falling behind. Imagine 10 people in a room. 9 of them make no more money this year than last year, but the 10th person's income triples. Add it all up, average it out, and the room just had a fantastic year on paper. 9 of the 10 people in that room would tell you the opposite. That's roughly what's happening at a national scale. GDP can climb, corporate profits can climb, the market can climb, while the typical household barely treads water. So here's the real question underneath all of this. If working harder and getting paid more isn't what's driving this divide, then what actually is? The answer is one word: ownership. Think about a rented apartment versus an apartment you own. If the value of that building doubles, the renter's life doesn't change. They still write the same monthly check, maybe a bigger one now. The owner's net worth just doubled while they slept. That's the entire divide in miniature. Wages get you income. Ownership gets you growth. And growth is what compounds year after year, while wages mostly just keep up with the cost of living, if you're lucky. Now the story gets even stranger, because
this gap doesn't stay still. It accelerates. Think of wealth like a modern operating system, quietly running in the background of your financial life, whether you notice it or not. If you own assets, that operating system is constantly updating in your favor, compounding your money while you sleep, while you're on vacation, while you're doing nothing at all. If you don't own assets, there's no operating system running for you. There's just the paycheck, arriving and leaving again on a loop. This is also why the richest households tend to benefit first and fastest whenever something like an AI boom hits. They already hold the assets that go up. When the value of those assets jumps, their net worth jumps immediately, automatically, without them lifting a finger. Picture a building with an elevator and a staircase, both leading to the same top floor. Asset owners are already standing in the elevator when the doors open. The moment the building goes up in value, they rise with it, instantly, without taking a single step. Everyone relying on a paycheck is on the staircase. They can still reach the top eventually, but it takes years of climbing, one step at a time, while the elevator riders are already there, waiting, wondering what's taking everyone so long. Everyone else has to wait for that boom to eventually turn into higher wages, more hiring, cheaper prices. History shows that trickle-down timeline is slow. Sometimes it barely arrives at all, and by the time it does, the elevator riders have often already moved up another floor. So where does that leave an ordinary person watching all of this from the outside? Not powerless. That's the important part. The uncomfortable truth is also the useful one. If ownership is what compounds, then the path forward, even a small one, runs through ownership too. Not a get-rich-quick stock pick, not trying to guess the next AI winner. Just consistently owning a small piece of the economy over time through simple, diversified investing, instead of only ever renting your financial life through a paycheck. But here's the pattern interrupt most people miss. You don't need a fortune to start standing on the ownership side of that K. A retirement account through work, a low-cost index fund, a small automatic transfer every month. These are boring tools. They were never designed to make headlines. But they're the same basic mechanism the wealthiest households are using, just starting from a smaller number. The size of the first check matters far less than most people think. What matters is being on the right side of the K at all, and staying there long enough for time to do the compounding for you. It won't close a 93% gap overnight. Nothing will. But it moves you from standing entirely outside the upward line of that K to at least having one foot on it. So let's go back to where we started. Record stock market, empty grocery carts. Both true on the very same day. Now you know why. The market isn't measuring how hard people are working. It never was. The market doesn't reward the hardest workers. It rewards